And joining me now is Rekopantsoe Nare from Anchor Capital with his take on what's playing itself out in midday trade. Reko, thanks so much for your time this afternoon. So let's start off by reflecting on that PCE print. It came in as expected, easing to 2.5% in January. This, however, not doing much to change the outlook for the Fed. We will probably still see them taking that wait and see approach, right?
Yeah, I can agree with that, darling. Thank you for having me. It's always great to be on the show. I think essentially what you're seeing is it's kind of a resurgence within inflation. And even if we take a step back and we think about the fact that, this is obviously PCE is the US Federal Reserve's preferred measure when it comes to kind of measuring inflation. Of course, they'll be watching that fairly sharply. And let's even take a further step back and think to ourselves, if we think of the Trump policies, if they are deemed to be inflationary, most investment houses are expecting that we'll probably see that inflationary impulse begin to, surge back in the second half of 2025. If it's as soon as that, then you can imagine the Fed will continue to take a wait and see approach for more information, for more data before it makes decisions. But for now, I think you to see more rate cuts going forward into the year. I think you probably see as per the line, which is to say a wait and see approach, as you've already highlighted.
With that being said, Rico, then how do analysts, traders position themselves in markets, because it does seem like we're in for very volatile times?
Even if you think of Friday's big story around the debacle between the president of Ukraine and the US president and US vice president, I think if you just take a page out of that book, what you saw largely market participants just taking a step. You had a huge US pension fund rebalancing happening on that exact same date. And basically what you saw traders really take their thumbs off of the trigger, if you will, and really take a step back. I think if you ask us how we're positioning ourselves, I think I'll probably say, we are falling in the line of cautious going into the rest of 2025. But I will say with that, we think that it does make sense to wait for information to really be confirmed, rather than just working on sort of speculative, what will President Trump, what will the tariff be, what will the tariff not be, rather wait to see what the implication is, rather wait to see the amount and the quantum, and then you position on the back of that.
Let's look at some company results out on the local front. Really a busy day, and let's start off with Bidvest. Earnings growth there slowing, so we are seeing growth but coming in slower than expected, and due to quite a few issues, including challenges in the bulk commodity space and downbeat sales for its renewable products. What have you made of that report in particular?
Yeah, I would say a mixed bag. You had some moderate growth, and then you also had, as you've already highlighted, some weak spots. But at a very high level, revenue up about 5.8% year on year, which was in line with expectation. You had HEPS at about 0.6%, which missed expectations. But what you are seeing is you're seeing strength within some parts of the business, specifically services, automotive rather, and branded products. That certainly did offset the weaknesses that we saw within freight and commercial products. When you dig into the cash flow side, what you see cash flows up about 18% year on year, which is pretty strong. And as you've already highlighted at the beginning of the show, R4.70 dividend, which is up about 1% since last year. So I'd say, a lot to take away, a lot there for both the bulls and the bears. But from our side, trades at an 80 or rather 11 times PE, which is about 10% below its 5-year average. So we think that there's good value there and potential upside, specifically if the services business does get spun off, as per the rumor.
Let's move over to RCL Foods. They've delivered a strong half-year earnings. It's interesting to see how, revenue from continuing operations only grew 5.4%, whereas the HEPS was up, over 30%.
Yes, so Ntoling, think about it. You've got an 8.6% move today, which just tells you that the market really did like what it saw out of that first half 25 result. But yeah, as you already said, strong earnings growth. EBITDA up about 25%, HEPS, as you already highlighted, up about 38%. And that was largely driven by margin improvements, specifically within groceries and baking. And then you also did see some recovery within the sugar part of the business on the back of some price setbacks that you've seen, and that was really industry wide. Dividend that got reinstated at about 20
Yes.
cents per dividend, which is on the back of having no payout in the prior period. So I think it does say that's a business that's reflecting some confidence, some cash flow beginning to filter through, profitability beginning to filter through as well. And I would say I'd highlight this and just say what you're seeing is operational resilience, and what you're seeing is cost saving, which is certainly working, and shareholders are looking at it.
Rico, you mentioned the share price uptick right at the top of your answer. How much of that uptick do you think is mainly on the back of that dividend being reinstated, and how much of it is mainly or maybe on the back of confidence within the company?
I would say, within the current economic environment, within the current market, I think shareholders are looking for value. So where dividends are being reinstated, where dividends are flowing, and that is sort of guaranteed, I think shareholders are certainly giving companies another look. And even if I think about RCL, I think for me, it's really a story of lower raw material costs, reduced load shedding impact, improvement within efficiencies within the business. So I'd certainly say, as a shareholder, you would look at that and say, that definitely does support earnings. And that's despite a very challenging macroeconomic environment, has already been highlighted.
And then let's move over to the property sector. Mass Real Estate managed to grow distributable earnings. The group listed locally, but really more of an international business operating in Europe. Talk to me about your reading on those numbers.
So I think there's two parts in Taoleng. The one part is the results itself, and then the other part is the deal that was then proposed. So I think just looking at the results itself, fairly strong financial performance. From a book value per share perspective, R1.78, slightly above expectations, dips up about 13.1%, which certainly did beat forecasts by about 13%. And then, of course, I guess the big story was around that deal, that strategic exit from PKM.
All right, let's just hit pause on the conversation. Before we get to your stock pick, let's reflect on some counters that have found favor with your industry peers.
Yeah, so I have a European stock pick today. A lot has been said about the rotation out of the US into European stocks, and that's driven up valuations. But there are areas of that market where really you haven't seen a lot of movement, and a lot of it is in these high quality consumer companies. So my pick today is Birkenstock. I'm wearing my Birkies as we speak. The company listed about 2 years ago. It came out of private equity, so very highly indebted. And they have done so much in terms of cleaning up that balance sheet, and with that set to continue. Manchester said they want zero debt. And I think that the prospect of much higher returns on invested capital and returns of equity going forward is quite positive. Free cash flow generation is quite solid, and the footprint is still quite limited. They've seen very good traction in the US for their product, but the store footprint is still exceptionally low. So I think that they'll continue to expand the store footprint, continue to grow the brand, and it's trading at a very undemanding forward PE, and quite a bit below kind of the consensus fair value currently.
As always, I'll stick local because I think there's still lots of value to be found here.
Okay.
So my pick is Rhodes Foods, so RFG Holdings. This is it's a small cap, but in the real world of packaged food manufacturing, they are a proper giant. They produce pies, juices, the Bull brand of canned meat, and they rank #1 in most categories that they produce. This is a business that generates about an 18% ROE. It has no debt, strong cash generation, and it's grown earnings over the past 5 years at about 17-18%. It's currently trading on like a 7 times multiple. It's as cheap as it gets. This is one of those little compounders that over time will continue to grow earnings and return cash to shareholders in quite a profitable way.
So Rico, RFG as well as Birkenstock, what have you made of those stock picks and the analysis that was just shared?
So I like RFG. I'm not such a fan of Birkenstock. Maybe it's not. Maybe it's because I'm not wearing my Birkenstocks right now. But so just at a high level, just starting off with Birkenstock, I think that was probably Chantal Marx, if I heard the voice correctly. So very well respected in the industry. But I think from my side, maybe what's positive is that you do have a global brand with a strong market presence. She already highlighted that very well established. But for me, it's just the space that it plays in. It plays in that consumer cyclical space, which means that it's very sensitive towards economic conditions. So we're not such fans of being in that or exposed to that space going into 2025. I think the reasons have already been highlighted when you think of just the shape of the consumer and even the shape of the consumer in the US and the data that we're getting out of there. And then when you dig into the business itself, 52% of that revenue comes out of the Americas, 36 comes out of Europe, which does highlight, some strength within its regional positioning. But it's a valuation story for me. While I'd step away from that, if it trades at at 29 times PE, if you compare that to the industry average of about 19 times, that's quite steamy from my side. And then it does make it more expensive than, for example, the likes of Lululemon within that space. But it is still, sort of cheaper than Nike. So really, it's a valuation story for me. The ROE I feel is relatively low, about 8.4%. But yeah, for me, premium valuation that does kind of increase the risk of a price correction if growth expectations are not met. And then very quickly, RFG. The reason why I like that story, as your guest already highlighted, HEPS up 18%, margin expansion, despite very weak regional volumes, and the international side of the business continues to grow. Volumes, we've seen those rebounding quite strongly. Dividend up by about 79%, so quite strong. And then, as your guest highlighted, net debt of zero. We definitely, certainly like that. But I think the bottom line is that it's highly attractive at that 7 times PE from our side, and it's really for us, at an ROE of about 17%. We think that that's quite value for money, as your guest already highlighted.
Okay, so then what's your stock pick? What are you hanging your hat on this afternoon?
So what I'm going to do is I'm going to stay offshore, and rather than focus on the US, I think a lot of asset managers have spoken about kind of looking past the US, just given sort of the rich valuations that it sits on. And I'll look at Novo Nordisk, which is a company that I think is fairly well known, specifically within its GLP-1 weight loss drug player. But I'm going to speak to it, really outside of just that. The stock has corrected from its peak of June last year. It's currently trading at about 22 times forward, with about 15 to 20% annual EPS growth. So we like that, and we expect that going into the next 3 years. But we specifically like that it's got strong business fundamentals, a diversified revenue base. If you think of the whole weight loss story, that only accounts for about 22% of sales. So we think that it's got a strong pipeline outside of that, and it's got a very stable shareholder structure that should support any long-term strategy or long-term strategy as it plays off. And as I've already highlighted, a big thing for me is debt. It has no meaningful debt, strong risk-adjusted returns that really position it for future growth. So that's why I'm going to choose Novo Nordisk, which is NVO, the ADR within the US.
So Novo, one to look out for. Rico, thanks so much for your time this afternoon. That was Rekopantsoe Nare from Anchor Capital.